Good evening, everyone. Welcome to last session of mine and this series of FM. And the last topic that we're going to do today is leverages. An interesting topic, just a one session topic, and uh, and also it's also important from the point of view of exams. Also, you may find this being tested quite often in the exams. So, without talking much, let's go ahead with the topic of leverages. Let's first talk of what do we mean by leverages. Well, this word leverages has actually been arrived from the concepts of physics. Um, I don't know anyone, most of you might have learned physics in your school days. So in the physics, we had a concept called as, this word leverages. As I said, it has been arrived from a this word lever. I'm talking about physics word, not the biology. Have you ever heard of this term lever in your physics? Maybe in your eighth or ninth standard. There used to be three different types of levers, type 1, type 2, type 3. The other basic tool you might have learned along with lever would be the pulley, which is used to draw water from the well. You might have also learned something called as a plank, plank to slide the heavy weights from one location to another. You might have learned about fulcrum, right? So uh, in this lever, let me just take certain examples of lever. Uh, one of the type of lever would be, this the seesaw, right? One of the types of lever would be the seesaw, where here you used to put the effort, and on the other side there used to be a load. Okay, uh, so effort and then followed by the load. So this is a lever is used to lift heavy loads with easier efforts. So, for example, if I talk of a cola bottle, we all know that cola bottles basically come with this type of packed, this type of packed sealing or the cap, and this cola bottle can be opened only with the help of bottle opener, right? So we need that bottle opener to open it, and that bottle opener used to be attached over here, and maybe it used to be connected like this. So bottle opener here, just need to put a effort, push it from the other side, the cap opens up, right? Now, obviously, you cannot open this bottle with your bare hands, right? So with your bare hands. Similarly, if you're traveling by road and you find that on the road, there's a big rock lying on the road. You cannot uh, remove this particular rock with your bare hands. You'll have to use maybe a typical rod, give it a push on one side, it slides with. Then again, you give push it on the other side, it slides on the other side, right? So we had these types of levers. Now, be it a case of seesaw or this type of rod or the bottle opener, in whichever case you say, what is the task that these particular apparatus are being useful for? They make our tasks easier, right? They make our difficult tasks to be performed in a very easy manner, and that's what we call it as a lever, right? We call it a lever. So that's what in physics we had the use of lever. In physics, we had the word lever, which was a synonym for the tools to perform difficult tasks with ease. Lever is basically the tools which are used to perform difficult tasks with ease. So that meant it provided you with less effort, more result. That provided with less effort, more result. Now, something of this sort, something of this fundamentally thing, we can also get it in finance also. In finance also, we are likely to see some this sort of phenomenon that where you put lesser effort, but you're likely to get more result. Let me just show you one of such case. Suppose we prepare an income statement for a company. We begin with sales. From that, let's reduce the variable cost, right? Then we have the contribution. Then you subtract the fixed cost to get earnings before interest and tax, right? And then we pay the interest. So we get profit before tax. From that, we deduct the tax to get profit after tax. These are the numbers, this is the income statement that we have. Now, suppose we are right now producing and selling 10,000 units. Suppose we are now right now producing and selling 10,000 units. Sales, let's say per unit, sales is 100 rupee and variable cost per unit is suppose 60 rupees. So in total, what is the amount of what is the amount of sales? 10,000 into 100, that's like 10 lakhs. Then the variable cost amounts to 6 lakh. So contribution will become 4 lakh. Fixed cost, suppose it is 1 lakh. So we have a EBIT of 3 lakhs. And then the interest is suppose another, say interest is 1 lakh 20,000. We have profit before tax as 1 lakh 80,000. Taxes are paid, suppose at the rate of 50%. Let's assume tax is at a rate of 50% for the ease of computation. The tax is 90,000 and we have a profit after tax of 90,000. Now with these units, 10,000, starting with these 10,000 units, we get a PAT of 90,000. I want you to perform one activity, which we will need it for understanding the concept of leverage. What I want to do is uh, increase these units. Let's say instead of 10,000, suppose your sales is increasing by 10%. It means the units that you're going to sell is 11,000. You're supposed to prepare this entire income statement. Similarly, check for reduction in the units by 10%, which will make the units as 9,000. 9,000 units. And then again, we are going to get the entire income statement. Okay, so just try to calculate these guys. Just give you a couple of minutes. Go through this statement and calculate all these numbers, because based on those calculation itself, we are going to uh, observe what is this leverage all about. Leave some space basically in between so that we can actually write down certain fundamentals. Come on, let's calculate the numbers for 9,000 units and for 11,000 units. Quickly prepare this income statement, because post that only we'll be able to understand what do we really mean by leverages as a concept. Okay, let me just put it. So for 10 lakh sales has increased by 10%. Since you're selling 11,000 units, the sales will become 11 lakh. Variable cost will be 6 lakh 60,000. Contribution will be 4 lakh 40,000. Is the interest cost going to, or is the fixed cost going to increase with the increase in units? Of course, no. Fixed cost is going to remain same. EBIT will become 3 lakh 40,000. Interest will be 1 lakh 20. PBT will be 2 lakh 20,000. Tax is 1 lakh 10,000 and PAT is 1 lakh 10,000. Now coming to the units of 9,000, we find sales as 9 lakh. Variable cost will be 60 per unit. So variable cost will amount to 5 lakh 40,000. Contribution will be 3 lakh 50,000. Fixed cost remains same as 1 lakh. So your EBIT will be 2 lakh 60,000. Interest will be 1 lakh 20,000. PBT will be 1 lakh 40,000. Tax at the rate of 50% will amount to 70,000. Profit after taxes 70. I hope you guys have got this. Yes. Yeah, 1 lakh 10,000 profit in the increased case and 70,000 profit in the decrease. Now, we knew all these calculations, but what we want to observe is, let's have an impact. Let's have a look at it. What is the percentage change happening? Sales increased by 10%, right? Because it became from 10,000, if it increased to 11,000, there is a 10% rise in it. If you look at the contribution, that also is increasing by 10%, right? But if you observe the change in the EBIT, if you observe the change in the EBIT, that's not 10%, that is something more than 10%. Okay, that is something more than 10%. So 3 lakh increases to 3 lakh 40,000. So there is an increase of 40,000. So if you say 40,000 upon 3 lakh, that will give us a number which is definitely more than 10%. So let's have a look how much it is. So it increased by 40,000 divided by, which is 13.33%. This is plus 13.33%. PBT, there is an increase of 2 lakh 20,000 divided by 180,000. So here the PBT is increasing by 22.22%. Because you see 40,000 on 1 lakh 80,000. So 22.22%. And even the PAT, you will find that the increase in PAT is also 22.22%. Now, this is what I was talking about leverages. See, when you're putting small effort, when you're putting 10% effort in increasing the sale, when you're putting 10% effort to increase the sales increase from 10 lakh to 11 lakh by just 10%. But the resultant impact on EBIT, you observe that it is 13.33 times, right? So it is 13.33%. So basically, a 10% effort leads to 13.33% result in the form of EBIT. And a 10% effort in sales leads to 22.22% result in profit after tax. Okay. So 10% increase in sales causes 13.33% increase in EBIT and 22.22% increase in PAT, right? So if we talk of effort and result part, effort on one side, we say it is sales, and if I say result is EBIT, what we observe is 10% effort leads to 13.33% result in the form of increase in EBIT, right? So if I ask you how many times or your sensitivity of EBIT with respect to sales, we will say for every 1% change in sales, there is 1.33% change in EBIT, right? And this is what we call it as operating leverage. So operating leverage is percentage change in EBIT upon percentage change in sales, right? So if you say percentage change in EBIT, it was 13.33% change upon 10%, which is 1.33 times. Percentage change in EBIT upon percentage change in sales is 1.33, which means if you put 1% effort in increasing your sales, the result on EBIT is 1.33 times of it. Put 1% effort on increasing the sales, the result that you see is 13.33, sorry, 1.33 times of your result of the effort that you're putting. So when we are connecting sales with EBIT, we are talking of operating leverage. So this operating leverage is percentage change in EBIT upon percentage change in sales, or we also call it as this is a derivative of EBIT with respect to sales. This is simply change in EBIT due to change in sales is what we mean by the operating leverage. So is this operating leverage good or bad? I can say both, because if you are increasing your effort by 1%, your result will increase by 1.33%. But if you're decreasing your effort by 1%, even the result is going to decrease by 1.3%. See, over here, this is decreasing by 10%. This is also decreasing by 10%. But EBIT is decreasing by 13.33%. And on the other hand, if you find PBT, that decreases by 22.22%. And here this also decreases by 22.22%. What we find is operating leverage of 1.33. It's good. Right? Operating leverage of 1.33 is good if you are putting in extra. If you're likely to reduce your efforts or if your sales are likely to fall, then it's going to be a difficult situation because your profits or the EBIT figure is also going to fall at a faster pace, right? So operating leverage is a replica for your business operating risk also. This is going to be a replica for your operating risk also, because operating risk or the operating leverage is like it's a scenario where it may be a good situation or it may be a bad situation. If you're putting in more efforts, if your sales are increasing, then it's a good thing. It will be paying you off in the form of higher EBIT, or it may even. So effort and result criteria is sales and EBIT. So here we say 1.33 times is what the operating leverage is. Now, how do we so operating leverage? Simply percentage change in EBIT or percentage change in sales. Now, similar case, if we talk of effort and result criteria, if an effort Let's say effort is your EBIT, and result effort is EBIT. And suppose if I'm talking of result as profit after tax, right? Result is your profit after tax. Then what is the resultant impact? We find that when my EBIT is increasing by 13.33%, then my PAT is increasing by 22.22%. So again, here the effort is going to pay you a higher degree of result. So we can say financial leverage. Here, financial leverage is EBIT, that is percentage change in EBIT upon percentage change in financial leverage is what is the percentage change in profit after tax upon percentage change in EBIT. The percentage change in PAT is 22.22% and percentage change in EBIT is 13.33%. So you can say this is going to amount divided by 13.33. That is 1.7 times. So it means if your EBIT is going to increase by 1%, your resultant impact in the form of PAT will be by 1.67. So conclusion wise, we can say if EBIT increases by 1%, PAT will increase by 1.67. EBIT increases by 1%, PAT will increase by 1.67%. Okay, are we good with this, everyone? That's your financial leverage. So, what is a financial leverage? It's again a measure of financial risk. It's again a measure of financial risk because you are going to pay interest, and that interest acts as a that interest actually acts as a multiplier, and that results in PAT increasing by a faster rate as compared to EBIT. But is it good or bad? Sir, both is good as well as bad because if there is a likely maximization of profit, there is also a likely maximization of the reduction in the profit or the losses. Okay, guys. That's where we say EBIT, if it increases by 1%, PAT will increase by 1.67%. Okay. Similarly, if we are combining sales, we start with sales being our effort and profit after tax being our result. So sales we increased by 10%. Result was, PAT increased by 22.22%. So if we talk of combined leverage is percentage change in PAT upon percentage change in sales. Percentage change in PAT is 22.22% upon 10%. That amounts to 2.22 times. Right? So it is 2.22 times. So putting up all the three forms of leverages is operating leverage is percentage change in EBIT upon percentage change in sales. Financial leverage, it is percentage change in PAT upon percentage change in EBIT. And a combined effect of both will be the combined leverage, which will be percentage change in PAT due to some percentage change in sales. Okay, so these are the formula for operating leverage, financial leverage, and combined leverage as far as the original meaning of the concept is concerned. Original meaning of the concept is concerned. We do have some shortcut formula also to calculate these leverages. Let's have a look at some of the shortcut formula. Let me just try out first with the operating leverage. Let's look at the shortcut formula. As we have seen, operating leverage is percentage change in EBIT upon percentage change in sales. Percentage change in EBIT upon percentage change in sales. So let's first go down and say, how do we compute this percentage change in EBIT? Can I say we call it as new EBIT minus old EBIT, the whole divided by old EBIT upon percentage change in sales is same as, if you observe the percentage change in sales, the sales change is 10%, variable cost change is 10%, even contribution is also changing by 10%. So we can simply call it as percentage change in contribution also. So we have EBIT new EBIT minus old EBIT upon old EBIT, all divided by percentage change in contribution will be new contribution minus old contribution upon old contribution. We can write this as revised form, new EBIT minus old EBIT upon old EBIT multiplied by old contribution, the whole divided by new contribution minus old contribution. Now, if you find the difference between EBIT and the difference between contribution, look at the question, look at the numbers. The difference in contribution, 4 lakh and 4 lakh 40, it is 40,000. Difference in EBIT, 3 lakh and 3 lakh 40, it is 40,000. Amount of difference is constant for both the cases. Be it the difference in contribution or be it the difference in EBIT. In both cases, the amount-wise difference is remaining same. Right? So amount-wise difference is just one and the same. So this case, it is just one and the same. We can cancel these because both the cases, it was 40,000 constant. That's always going to be the same. What we have as a formula for operating leverage, it is your original contribution upon original EBIT. That's your operating leverage. Similarly, what is the financial leverage? Financial leverage will be EBIT upon profit before tax. Financial leverage is EBIT upon profit before tax. And combined leverage is going to be contribution upon profit before tax. So these three are the shortcut formula for operating, financial, and combined leverage. Okay, are we clear with this three formula? Are you clear with these three formula? Are we clear with these three formula? Queries with these three formula, or else we can simply go ahead with some questions. Can we take sales in place of contribution? No, you cannot take in the numerator as contribution. Sorry, you cannot take as sales in the numerator. Then you won't be getting a perfect answer. It will be different answer because if you're taking sales, then we couldn't be canceling these two parts, right? So it has to be contribution upon EBIT. Okay, so we can go for some questions now. From the investor's point of view, these numbers indicate the degree of risk that the company has. Company has got two types of risk. One is the operating level risk, where the company's operations are going to face some risk. And the second aspect is the financing risk. So operating leverage takes care, or it's a measure of your operating risk. Financial leverage is a measure of financial. Okay. So financial leverage is an indication that if your EBIT is going to change by some percentage, what will the impact on PBT? A higher financial leverage will lead to higher impact on PBT. Lower financial leverage will have a lower impact on PBT. So basically, whenever there is any change in EBIT, due to the interest, what is the final impact on profit after tax or the profit before tax? That is what we are talking of as financial leverage. Okay, fine, great. Let's go for the questions. Our base is going to be this typical three formulae. Let's begin, guys. Uh, the question number one. We'll do the questions from this handout, followed by a question that we have in the RTPOs. Let's look at this question number one. Find out the operating leverage from the following data. We have sales is 50,000. Then we have the variable cost. Sales is 50,000. Variable cost, they're saying it is 60%. 50% means variable cost will be 30,000. And we get a contribution as 20,000. Sales, from that you subtract the variable cost, you get a contribution of 20,000. Then you have a fixed cost. Fixed cost of 12,000. Contribution less fixed cost would give you EBIT, earnings before interest and tax, is 8,000. So here, if you want to compute the operating leverage formula that we have, for our original formula, operating leverage will be contribution upon EBIT. Contribution upon EBIT, which is contribution is 20,000 and your EBIT is 8,000, which is 4 times. So your EBIT is going to be impacted, sorry, not 4 times, 2.5 times. Your EBIT is going to be impacted 2.5 times of the impact from the sales. Then the second part of question is you have to compute the financial leverage. Okay, so we've got the net worth question. The net worth of 25 lakh. And we have a debt equity ratio. Since debt upon equity is 3:1, Therefore, debt upon 25 lakhs is free. Therefore, debt will be 75 lakh. Debt will be 75 lakh, and on the debt of 75 lakh, you have 12% as the interest rate. Amount of interest will be 75 lakh into 12%. 75 lakh into 12%. That is interest amounting to 9 lakh. Now, to compute the financial leverage, we need EBIT. First, EBIT is 20 lakh. From that, you subtract the interest, which is 9 lakh. You get a profit before tax of 11 lakh. Financial leverage, as the formula says, it is EBIT upon profit before tax is 20 lakh upon 11 lakh is the financial leverage. Number for financial leverage, lakh divided by 11, which is 1.8182. Are we clear with the solution to question 1, guys? Everyone? Was quite easy question, basic number calculation. Are you good with this? Yeah. Why is EBIT 20 lakh? Because the question says it's operating income or the operating profit, and operating profit is your EBIT. Okay, let's go for question number 2 then. Following details are available for RST Limited for the year ended 31st March 2006. Uh, Operating leverage is 1.4, combined leverage is 2.8, fixed cost excluding interest is 2.04, sales is 30 lakhs, 12% debentures is 21.25 lakhs, equity shares of 17 lakhs. And calculate the financial leverage, we have to calculate the PV ratio and EPS. If a company belongs to an industry whose assets turnover is 1.5, does it have a high or low assets leverage? At what level of sales, earnings before tax of the company will be equal to 0? Okay, so we have got the sales figure, we've got the fixed cost, then we have the operating leverage and all. So fixed cost is given as 2.04. Let's look at operating leverage first. Let's look at the operating leverage. As per our formula, operating leverage is EBIT, not EBIT, contribution upon EBIT, right? We can rewrite this formula as, instead of just EBIT, we can say it is contribution upon contribution minus fixed cost, and that is equal to 1.4, right? So we don't know what's the contribution, but the question has given us the fixed cost excluding interest as 2.04 lakhs. 2 lakh 4,000 is 1.4. Therefore, just multiply it. You can say contribution is 1.4 contribution minus lakh 4,000 into 2 lakh 85, right? So 2 lakh 85 600 divided by 0.4. Contribution, you need to just rearrange this. 2 lakh 85 600 is equal to 1.4 contribution minus contribution. This zero point 0.4 contribution is 2 lakh 85 600. 600 divided by 0.4. The contribution is 7 lakh 14,000. Correct? For the contribution from the operating leverage part as 7 lakh 14,000. Then the question also says combined leverage is 2.8. So since combined leverage is 2.8, and they have given the operating leverage as 1.4. Operating leverage is 1.4. And we know since combined leverage into financial leverage, sorry, operating leverage into financial leverage is equal to combined leverage. Operating leverage into financial leverage is equal to combined leverage. Therefore, combined leverage, operating leverage will be 1.4 into financial leverage is something not known, and combined leverage is 2.8. Financial leverage is 2. Okay. Financial leverage is 2. We have to compute the financial leverage. Then if we have this financial leverage, now we can use the financial leverage formula as EBIT upon profit before tax. We can get the interest out of it. We can just verify it accordingly. We have the EBIT? No, we have a contribution, but let's use operating leverage is contribution upon EBIT. Operating leverage is 1.4, wherein the contribution is 7 lakh 14,000 upon EBIT. So EBIT will become 7 lakh 14,000 divided by 1.4, which is 5 lakh 10,000. Financial leverage is EBIT upon PBT. So 2 equal to 5 lakh 10,000 divided by PBT will give us a profit before tax figure of 5 lakh 10,000 divided by 2, which is 2 lakh 55,000. Okay, So let's begin with the income statement. Sales they have given us in the question as sales was given, right? Sales was 30 lakhs, right? Less variable cost, which we don't know. That gives us contribution. Contribution is 7 lakh 14,000. Variable cost is 24 lakh 30 lakh minus 7 lakh 14,000 is 22 lakh 86,000. Sales is 30 lakh less variable cost is 22 lakh 86,000. We get a contribution of 7 lakh 14,000. From that, we are going to reduce the fixed cost. Did we get a fixed cost? Yes, 2 lakh 4,000. We get a EBIT of 5 lakh 10,000. From that, you are going to pay the interest. Interest is something which we haven't computed, but we have the figure for profit before tax, which is 2 lakh 55,000. It means interest will be 2 lakh 55,000, right? And then from that, we are going to subtract the tax. We have the tax rate given to us. Yeah, 30%. Less tax rate 30%, 2 lakh 55,000 into 30% is 76,500. That will give us a profit after tax figure of lakh 55,000 minus 76,500 is 1 lakh 78,500 is a profit after tax. This we are going to divide it by number of equity shares. Number of equity shares is 1 lakh 70,000. EPS will be 1.05, right? EPS is 1.05. Now let's look at what all things the questions are asking. Calculate the financial leverage, that is done. Calculate the PV ratio and EPS. EPS is done. We can get the PV ratio also. PV ratio is contribution upon sales. Contribution is 7 lakh 14,000 upon sales of 30 lakh. 714 divided by 30 lakh will give us a PV ratio of 23.8%. Then with PV ratio, then EPS, if the company belongs to industry whose asset turnover is 1.5, does it have a high or low asset leverage? So we need to look at the asset turnover of the given entity. Let's compute the asset turnover. Asset turnover. Now, as the asset turnover is, we'll say sales divided by asset. So sales is 50,000. Sorry, sales was 30 lakh upon total assets of the entity. Now, total assets of the entity will be equal to, can I say, total liabilities of the entity, which is 30 lakh. Total liabilities will be equity and the debt. Total liabilities will be 21.25, 21 lakh 25,000 and 17 lakhs. 30 lakh divided by 38 lakh 25, 0.78 times. This is 0.78 times, right? So we say it belongs to industry whose asset turnover is 1.5. And here our asset turnover is 0.78 times. Of course, we are having a low asset leverage or low asset turnover, at what level of sales the earnings before tax will be equal to zero. We want to know at what level of sales EBT will be equal to zero. So here we have to do this same calculation, but in a reverse pattern, right? Because we want to know uh, when our profit before tax is going to become zero. Okay. So profit before tax should be zero. Just now, what level of sales? Of course, if the sales changes, variable cost is going to change, and even the contribution going to change. Fixed cost will remain constant. EBIT is going to change, and we want this PBT figure to be zero. For profit before tax figure is zero, then EBIT will be 2,55,000, right? Because from the EBIT of 2,55,000, interest is paid. You get a profit tax of zero. Fixed cost is 2,04,000. What will be the contribution? So do the reverse calculation. We need to have a contribution of 4,59,000, out of which 2,04,000 fixed cost will be paid. So now, how do we get the sales figure? We know the PV ratio is 23.8%. 23.8%. Sales is 100%. So variable cost should be ideally 76.2. If we do the reverse calculation, the cross multiplication part, we can say 4,59,000 divided by 28 is 19,28,571. 19,59,570. Okay, so at a sales of 19,28,571, find that the PBT becomes zero. We're done with this question number two. Quite an exclusive one. Any issues with this? Problem, or are we good with this question two? Everything clear for question number two? It was quite a lot of calculations. Is it clear, everyone? Understood? Clear? Okay. Then let's go for question number three, guys. Proceed with question three. Again, an interesting question. From the following, prepare income statement of the company. PBT is zero, no? Mr. Bandi, you are asking for, yeah, this is earnings before tax. This is profit before tax, not earnings before interest and tax. Question three. From the following, we have to prepare income statement of company ABC. Briefly comment on each company's performance. Company ABC, we've got the financial leverage numbers, interest, operating leverage is given, variable cost as a percentage of sales is given, and income tax rate is given. Okay. So let me do it for company A. So as far as company A is concerned, we have to prepare the income statement. Of course, income statement has to be prepared from sales. Sales less variable cost will give you contribution. Less fixed cost will give you EBIT. Less interest will give you profit before tax. Less tax will give you profit after tax. Okay. So now, as far as the numbers are concerned, we have got a interest of 200 rupees. So let me just put that 200 interest over here. Okay. Financial leverage is 3 is to 1 and 4 is to 1. Variable cost as a percentage of sales is 66 2 by 3%, and income tax rate is 45%. Tax is at the rate of 55%. Variable cost is 66 2 by 3. So basically it is 2 by third. 2 by third of sales. Okay. So we have been given information about financial leverage and operating leverage. Operating leverage is 4 is to 1 and financial leverage is 3. Operating leverage is 4, financial leverage is 3. Let's try to begin with this. Now to start with, we have the interest figure available. Now, which is the leverage which is connected with interest? Tell me, guys, which is the leverage which is connected with leverage? The leverage which is connected with the interest aspect. Is the leverage aspect connected with the interest? Is it operating leverage or is it financial leverage? Which leverage is connected with interest? Operating leverage or financial leverage? Financial leverage, right? So let's use the financial leverage number. Financial leverage is EBIT upon PBT, right? We can rewrite this EBIT upon PBT as EBIT upon EBIT minus interest. And this is equal to 3. So EBIT is something which we don't know. Let's keep as it is. EBIT upon EBIT minus interest of 200 is equal to 3. We can cross multiply the things and get the appropriate values. Cross multiplication will be EBIT is equal to 3 EBIT minus 600. So let's take EBIT on one side. So we have 600 is equal to 2 EBIT, and therefore EBIT will be 300. Earnings before interest and tax works out to be 300. So let me just write down the earnings before interest and tax. Yeah, 300. So it means profit before tax will be 100. Tax will be 45 rupees. That will be 55. Now, the next leverage that we have to use is operating leverage. Now, operating leverage is simply contribution upon EBIT. So we can simply divide it and get the values. So operating leverage is contribution upon EBIT. Operating leverage is contribution upon EBIT. Um, we don't know what is the contribution, but we know the EBIT as 300, and accordingly the operating leverage will be 4. Given in the question as 4. So therefore our contribution number will be 300 into 4, which is 1200. Okay, so contribution is 1200. Now, since the contribution is 1200 and EBIT is 300, as a difference, it is fixed cost is 9. Contribution is 1200. So we're done with contribution till PAT. Only the sales and variable cost component is pending. Can you tell me what will be variable cost and sales figure for this? Anyone, guys? Can you tell me what will be the contribution and variable cost and the sales figure? Just tell me the variable cost and the sales figure, guys. Variable cost is two-thirds of sales. Contribution is 1200. How do we get the sales and variable cost figures? Sales is 2000, the sales is 3600, and variable cost is 2400. Okay, simple. Since your variable cost is two-thirds, you can say if your sales is 1, variable cost is one-third. Well, question stated. Variable cost to be two-thirds, right? If your variable cost is two-thirds for 1, you have a variable cost as two-thirds and contribution is one-third. So what we can say is contribution is one-third for 1200. So accordingly, what will be the whole value for as far as sales is concerned? It is 3600 upon subtract the 2400. Sales variable cost is two-thirds and the balance one-third is the contribution. Are we good with this entire calculation, guys, for the company K? The entire cost of company A. We good with this? Is everyone clear with this part of company A? Everyone, the question one, company A clear? Clear, everyone? Okay, then similarly, can we do it for company B and C on your own? Can you solve for company B and C on your own? Yes or no? Can we solve it for company B and C? Yes. Okay, so you can just quickly take down the numbers. I've anyways uploaded this on portal. If you're not able to find it on portal, please copy down the numbers for company B and C. Please copy the numbers for company B and C. I'll give you 2 minutes time, and then post that we'll have that time period to solve with a break in between. Write down the numbers for company B and C, guys, quickly. Okay, I think this is quite a good amount of time to copy the numbers. How much time would you need to solve both B and C, guys? Tell me. For both B and C, what's the time that you will need for solving both B and C? Is 10 minutes sufficient? 10 minutes sufficient to solve for both B and C? Yeah. Anyways, are you good with 10 minutes sufficient for solving both B and C? Yes? Okay. So in that situation, let's do one thing. Uh, let's take a break of 5 minutes and post that in next 10 minutes you have to solve both B and C. I assume you might have copied the question. Take a break of 5 minutes, post that another 10 minutes you will have for solving it again after 15 minutes in total. By end of 15 minutes, you should be done with the questions. And both B and C should be solved, just like A. Let's take a break, guys. Okay. So I think everyone has solved this part B and C. Part B and C. Just I want the figures for B and C. Sales is 8,000. Is it true, guys? And for C, it is 1,000. For C, it is 12,000. Okay. Less variable cost from 8,000. We have the variable cost. Sales is 8,000. Variable cost is 6,000. Contribution 2,000 and 6,000. Fixed cost is 1,600 and 4,000. And EBIT is 400 and 2,000. Interest is 300 and 1,000. We get profit before tax of 100 and profit before tax of 1,000. Tax at the rate of 45. So this is 55 and here it is 450. Profit after tax is 550. Okay, so we're getting these numbers. Let's verify, guys. Are you all getting this B and C? Okay, guys. So let's go for the next stage where we are going to look at the financial leverage when there is preference dividend. Financial leverage. Financial leverage in case of preference dividend. Okay, so let's have a look at it. Remember, if the company pays preference dividend using the formula of EBIT upon profit before tax is incorrect. If I use this EBIT upon PBT formula for financial leverage, this is totally incorrect. EBIT upon PBT is incorrect for the financial leverage, right? EBIT upon PBT we cannot use for financial leverage because there is an additional layer of financial leverage that is getting added, which is the preference dividend. So, whenever we have this sort of financial leverage in case of preference dividend, we generally calculate financial leverage as percentage change in profit or percentage change in net profit for equity shareholder upon percentage change in EBIT. Okay, so that's going to be percentage change in net profit for equity shareholders divided by percentage change in EBIT. This is the typical formula that we are going to use. If we talk of the shortcut formula for this, the shortcut formula for financial leverage when preference dividend is involved, we say it is EBIT upon PBT minus preference dividend upon 1 minus tax rate. So we are grossing up the preference dividend with after tax figure and then subtracting it with PBT and getting EBIT. Okay, so EBIT upon PBT minus preference dividend upon 1 minus T is the financial leverage. Now, let's just verify this with the help of a example. We can simply take up this question also. Question 4. Let's get it with question number 4. The operating income of textile firm amounts to 1,86,000. Now, when I say operating income, we're talking of EBIT. Talking of EBIT, earnings before interest and tax of 1,86,000. It pays 50% tax on its income. Its capital structure consists of following. Obviously, from EBIT, we are going to subtract the interest, which is 14% of 5 lakh. Now, 14% of 5 lakh will amount to 5 lakh into 14%, 70,000. We get a profit before tax of 1,16,000 profit before tax. From that, we will subtract the taxation. Tax rate is 50%, so 1,16,000 into 50% is 58,000, wherein profit after tax figure is 58,000. Profit after tax figure is 58,000. Okay. So we have PAT of 58,000. Now, from this, we are going to pay the preference dividend. Preference dividend amount is 15,000, and therefore we have net profit for equity shareholders as 40. Right? So net profit for equity shareholders is 43,000. Net profit for equity shareholders is 43,000. Then determines the firm EPS, determine the percentage change in EPS associated with 30% change, and all such. And then we have to compute the financial leverage. What additional data do we need for operating leverage? To get the EPS, we need to divide this by number of equity shares. Let's divide this by number of equity shares, which is 40, no, 4 lakh, 4,000. Number of equity shares is 4,000. So we get an EPS of 43,000 divided by 4,000. EPS of 10.75. Determine the percentage change. Now we have got the EPS figure. Determine the percentage change in EPS associated with 30% change in EBIT. Associated with 30% change in EBIT. So what is the change in EPS that we are going to observe if we are taking 30% change in EBIT? Let's say this EBIT is increasing by 30%. So what will be the resultant impact? That is what we are likely to calculate. 1,86,000 increase it by 30%. This becomes 2,41,800. Interest of 70,000. This is 171,800. On that we have 50% tax. 85,900 is the tax. PAT is 85,900. Preference dividend is 15,000. Net profit for equity shareholder is 70,900. Dividing this by 4,000 will provide a EPS 17.725. EPS of 17.725. That's what we have done with the second part. What is the percentage change in EPS? Okay, we want to know what is the percentage change in EPS. Percentage change in EPS is 17.725 minus 10.75 upon 10.75. That is actually 17.75 minus 10.75 divided by 10. Okay, 64.88 times 64.88% is the change in the EP. Okay, so now they are asking us what determine the degree of financial leverage. So financial leverage, there are two methods as we have stated. For financial leverage is percentage change in net profit for equity shareholders upon percentage change in EBIT. Now, what is the percentage change in net profit for equity shareholder? This we can say it is 70,900 minus 43,000 divided by 43,000. 70,900 minus 43,000 divided by 20,000, 3,000 is divided by 43,000 0.6488, or this is like 64.88%. Then percentage change in EBIT is anyways 30%. So financial leverage is 2.16 times. If we use the shortcut for financial leverage will be as we have stated in the formula, EBIT upon profit before tax minus preference dividend upon 1 minus T. EBIT is 1,86,000 upon profit before tax is 1,16,000 minus preference dividend of 15,000 divided by 1 minus tax rate of 50%. So this is 1,86,000 divided by 15,000 divided by 0.5, which is 30,000 minus 1,16,000, 86,000. Just divide this 186 divided by 86, that is 2.16 times. Either use a long cut or the shortcut, we are going to get the same financial leverage answer. Question 4, is it clear? Good with this question 4. Did we all get the financial leverage formula for the preference dividend case? We play with this financial leverage when preference dividend is involved? Yes. Okay, so in question 4, what comes percentage change in EBIT? That is 30%. Is there in the question, no? 30%. Okay, let's go for question number 5. With this question number 5, guys. Calculate the operating leverage, financial leverage, and combined leverage from the following data under situation 1 and 2 and financial plans A and B. Installed capacity is 4,000. Actual production and sales is 75% of capacity. Selling price is 30. Variable cost is 15. And there are situation 1 and 2 with fixed cost as 15,000 and 20,000. Capital structure is financial plans A and B, equity and debt. Equity is 10,000, 15,000. Debt is 10,000, 5,000. The capital still remains 20,000 for both the cases. We have to compute for financial plans and for situations. So we are going to have 4 different columns. In this case, we're going to have 4 different columns for financial plan 1 and plan A, and then situation 1 and then situation 2. So we'll talk of plan A. Situation 1, situation 2. Plan B is situation 1 and situation 2. So let's write down the capital structure first. Capital structure is equity and debt. Equity is 10, 10,000 and 15 and 5. So under plan 1, it is 10, 10,000 for both. And in plan B, it is equity is 15 and debt is 5. This is totaling to 20,000. Okay, now there are 2 situations given, and for each situation, you have a different amount of EBIT or the units basically. So in situation 1, fixed costs are varying. Okay, fixed costs are varying as 15 and 20,000. So let's begin with the first part, which is units given to us. Units are 4,000 units multiplied by 75%. 4,000 units multiplied by 75%. So that is 3,000 units. So that gives you a sales figure of selling price is 30. So 30 multiplied by 3,000 is 90,000. So sales is similar for each one of them. Less variable cost is also 15 per unit. So if it's 15 per unit, so that comes out to be 45,000. You get a contribution of 45,000. Up to contribution in all the 4 columns, it is same. What is going to be different the amount of fixed cost. Under situation 1, fixed cost will be 15 or 20,000. You get EBIT of 30,000 from fixed cost. You subtract fixed cost from contribution, you get EBIT. And from EBIT, you're going to subtract interest. That is at the rate of 20%, 2,000 for the first two columns, and then it's going to be 1,000 for the remaining ones. This is profit before tax of 28,000. Okay, now then we have operating leverage. 45,000 divided by 50,000 contribution upon EBIT. 55 divided by 30, 1.5. Operating leverage is again 45,000 divided by EBIT of 25,000. Then here it is financial leverage is 30,000 upon 28,000. 25,000 divided by 23,000. Twenty-five divided by 24. We got the operating leverage, financial leverage, and then also the combined leverage. Then 45 divided by 29. This is 1.875. We are ready with all the leverages. Are we all getting these leverage numbers? Please verify, guys. Please check. Are we getting this? Completed? We clear with this question number 4. Sorry, question 5, guys. Question of leverage. Okay. Fifth is done. Let's do one thing. Let's look at question number 10 now. Sale revenue of TM Excellence is 20 per unit of output is rupees 20 lakhs. Sale revenue of TM Excellence is 20 per unit of output is 20 lakhs and contribution is 10 lakhs. At present level of output, degree of operating leverage of company is 2.5. The company does not have any preference shares. Number of equity shares are 1 lakhs. Well, question 10. The sale revenue of TM Excellence Limited at rupees 20 per unit of output is 20 lakhs and contribution is 10 lakhs. At the present level of sales, degree of operating leverage of the company is 2.5. Company does not have any preference shares. Number of equity shares are 1 lakh. Applicable corporate income tax rate is 50% and the rate of interest on debt capital is 16%. What is the EPS at sale revenue of 20 lakhs and amount of debt capital? If a 25% decline in sales will wipe out the EPS. So sales is 20 lakhs. We have the contribution of 10 lakhs. So from that, we will subtract the variable cost. You get a contribution of 10 lakh. Variable cost is 10 lakh. Contribution is 10 lakh. At present level of output, degree of operating leverage of company is 2.5. Okay, so we have degree of operating leverage as 2.5 and degree of operating leverage is computed as contribution on EBIT less interest, not less interest. What the fixed cost will give us EBIT. So degree of operating leverage is 2.5 equal to contribution of 10 lakh upon EBIT. EBIT is 10 lakh divided by 2.5. So 10 lakh divided by 2.5 will give us 4 lakh. Yeah. Right. EBIT is 4 lakh. Fixed cost will be the balancing figure. 6 lakh. Okay. So next part is the company does not have any preference shares. The number of equity shares are 1 lakh. Let us subtract from this. Rest is profit before tax. And do we have the tax rate given? Tax rate is also given. Yes. Yes. Tax will give us profit after tax. This subtract the interest. Rate of interest on debt capital is 16%. Well, we have the amount of debt given in the question. The company does not have, it doesn't have. But number of equity shares is given as 1 lakh. Applicable corporate income tax rate is 50%. The rate of interest is 16%. What is the EPS and the amount of debt? If 25% decline in sales will wipe out EPS. Now, this is a really interesting part over here because they say 25% decline in sales will wipe EPS. 25% decline in sales is going to wipe out the EPS. So we can say percentage change in sales is given as 25% and percentage change in EPS is 100%, right? Because if it's going to wipe out EPS, the entire EPS will become zero. So EPS will fall to 2 lakhs, which is 100%. So what is the impact of this? Which leverage can we say is getting connected with sales and EPS? If I want to collect the top line and the bottom line, which is the leverage which we can refer from sales and EPS? Which is the leverage which we can connect sales and EPS? Which is the leverage which we can connect sales and EPS? Tell me guys, what is the leverage that we can use to connect the sales and the EPS numbers? Is it going to be operating, financial, or combined? Of course, the combined ratio, combined leverage, right? We have the combined leverage as percentage change in EPS upon percentage change in sales. The percentage change in EPS is 100% and percentage change in sales is 25%, which is 4 times. Combined leverage works out to be 4 times X. Of course, for combined leverage, we do have a shortcut formula also. Combined leverage formula is contribution upon profit before tax. 4 is equal to contribution is 10 lakh upon PBT, which we don't know. We have to compute the PBT. So profit before tax can be simply computed as 10 lakh divided by 4. Therefore, profit before tax is 2 lakh 50,000. So as a balancing figure, interest will be 1 lakh 50,000, right? And the tax rate given is 50%, which is 1 lakh 25, and PAT is 1 lakh 25,000. Right, so we completed this income statement. Okay, so rate of interest on debt capital is stated as 16%. Rate of interest on debt capital is 16%. So we'll say interest is interest is 1 lakh 50. Amount of debt capital, interest on debt capital is 16%. So amount of debt 1,50,000 divided by 16%. It is 9,37,000. Debt is 9,37,000. So amount of debt capital is done, and EPS. What is the EPS at sales revenue and the amount of debt capital? So that's done. Yeah, so we have done with the entire question. Rather, I'll just take it on the other side to show you the full value. Is this question clear, everyone? Question number 10, a bit tricky, but quite an interesting question. Is this clear to everyone? Is this question clear? Because then I would like to take up, the RTP question for this chapter of leverages. Is this question clear to everyone? Yeah. Then let's look at the RTP question. Go through this RTP question. We'll discuss this question for the rest of the class. RTP question, let's have a look at it. Yeah. Okay. Question number 4. Question number 4 from the RTP, guys. Let's look at the RTP question. From the following financial data of company A and company B, prepare their income statements. So company A and company B, we have variable cost as 88,000 and 50% of sales is given. Then the next part is we have got the fixed cost. Let me just do one thing. Let me just copy this question here that you can have a quick reference to it, right? The following financial data of company A and company B, prepare the income statement. We have variable cost given, fixed cost is there. For company B, there's no fixed cost. Interest expense is given, financial leverage, margin of safety is given, income tax rate is given, and EBIT is given as 14,000. Okay, so these uh, dash numbers are something which we have to maybe compute these things, because as far as if you look at the solution also, question number 4. Yeah, we do have these fixed cost numbers. We need to calculate these aspects. So Let's begin with first aspect, which is of uh, financial leverage is given. Financial leverage is given for company A. So let's prepare the income statement for company A first. Financial leverage is 5. This financial leverage is computed as contribution financial leverage is contribution upon EBIT. 5 is equal to, now we can say this is contribution upon contribution minus fixed cost. So 5 is equal to C upon C minus fixed cost of 26,500. 5C minus 26,500 into 5. 4C is equal to 1,32,500. We get the contribution divided by 4, which is 33,125. Right? So we get a contribution of, this is the problem, Interest is, oh, my bad. I took a wrong formula, my bad. As far as company A is concerned, financial leverage is computed as EBIT upon EBIT minus interest. We get financial leverage of 5 is equal to EBIT upon EBIT minus interest of 14,000. Okay, interest of 14,000. So 5 is interest upon EBIT minus 14,000. That will solve the EBIT and will give you 17,500 as the EBIT figure. Now, of course, since we have EBIT, we can get the contribution also by adding fixed cost to EBIT. That will give us 17,500 plus 26,500. That will be 44,000. Sales will be contribution plus variable cost, which is 44,000 plus 44,000 contribution that we got. And the variable cost that's given in the question, 88,000. That is 1,52,000. Okay. As far as company B is concerned, operating leverage. Remember, for the operating leverage, we have this another formula of 1 upon margin of safety. You can just take it as a formula. And remember this, that operating leverage will be 1 upon margin of safety, and that's contribution upon EBIT. Now, in the question, they have given us the margin of safety 1 divided by 0.25 is contribution upon 14,000. Contribution is 56,000. Fixed cost is contribution minus EBIT. 56,000 minus 14,000. That's contribution minus EBIT of 42,000. Contribution will be 50% of sales, as variable cost is 50% of sales. Sales is 56,000 into 2, which is 50% of sales is the variable contribution. Therefore, sales will be double of the contribution figure. Okay. And you can just look at the income statement also. Okay. If there's any queries with regards to the topic, I can address it now, or else I can just call it a day. In the company A, EBIT upon EBIT minus interest, we can take company A, EBIT upon EBIT minus, yes, they have taken, we have considered the same. Here, everyone, margin of safety is the sales over and above the break-even point, the point at which your total cost is recovered. over and above whatever sales you're making, that's your margin of. Because margin of safety was given, so you have to use for operating leverage 1 upon margin of safety whenever the question gives such information. Or else you can use contribution upon EBIT formula. Since there was no other information to compute the operating leverage, we computed using the margin of safety. Okay, all things are clear. Fine. So then in that case, let's just stop here and let's call it a day. All the best, guys, for your exams in the upcoming month of May. The best. Bye bye and take care. Yes, sir.